Peter Schiff, CEO of Euro-Pacific Capital, joins us live from Connecticut. Peter, market seems to be telling us, despite the solid economic numbers that we saw in the housing market and amongst the consumer, the growth prospects in the US are in jeopardy if the fiscal cliff isn't resolved.
Well, first of all, I think it's really a propaganda victory for the U.S. government that they've actually convinced the markets that the danger is that we actually do something about reducing the budget deficits. The real danger is that we don't go over the cliff and the budget deficits get bigger and bigger. And I also disagree that we have solid economic data. The fact that consumers are confident enough to spend more borrowed money on imported products, that doesn't mean the economy is actually doing well, or the fact that the Fed has been successful in artificially lifting home prices with cheap money, when the fact of the matter is real estate prices are too high and lower real estate prices are part of the solution. Keeping them artificially high just makes the problem worse.
But are we not seeing some real momentum now, some real traction in the US housing market?
No, there's no real traction there. Remember, the only reason that the market isn't moving lower is because interest rates are at 0%, the government is guaranteeing all the mortgages, and then the Federal Reserve is buying all the mortgages in the secondary market. It is a completely artificial bubble. They're trying to reflate it. It's not going to work, and not only that, it's going to undermine a real recovery because we are diverting resources to housing that are badly needed in other areas, such as, real production, manufacturing. We have to start producing some of the goods that we're consuming. We can't keep borrowing the money from the Asian economies that are producing all these things, because eventually the Southeast Asian economies are going to get tired of vendor financing a deadbeat customer. Because unfortunately, no matter how much money Asia loans to America, we're never going to pay it back. It's not even possible.
Right, if you strip away all the liquidity support that we are seeing in the markets and in the broader economy, Peter, how would you describe real underlying demand?
Well, I mean, look, demand is always, infinite. People want things. I mean, the key is to produce things. And in America, we're not producing. People can want all kinds of stuff, but we don't have the capacity to produce the products. That's why we have to suck in all the imports from other countries, because our economy is not capable, with all the regulation, all the taxes, we're not able to produce the things that Americans want. And what we've conned the world into doing is supplying us with those goods on credit. But what we really need to do in America is not focus on demand. We have to focus on supply. We have to get Americans working productively to produce the things to satisfy what is basically unlimited demand, because everybody wants everything. The key is, how do you supply, how do you satisfy those demands with real goods? How do you produce consumer goods? And you need investment, you need savings, and unfortunately that's what we're lacking in the United States.
Peter, you say that the U.S., in your notes, needs deep and prolonged austerity to get back to real growth. Are you suggesting that we go over the fiscal cliff?
Well, I'd rather go over a steeper cliff that was mainly spending cuts. The unfortunate part about this cliff is, A, it's not nearly big enough to do the trick. B, it's over 80% tax hikes, and in particular, there are a lot of taxes that are going to fall on capital, on savings and investment. We shouldn't be raising those type of taxes. To the extent that the government gets more revenue, it should be consumption-based. It should be taxing people for spending money, not earning money, saving and investing their money. But of course, we need real cuts in government spending, not just these make-believe cuts that we have as part of the fiscal cliff, but we need real serious reductions, much bigger than we're talking about, because the government needs to free up these resources so that the private sector can use them more productively. Right now, the government is an enormous drain on the private sector, and they're preventing the private sector from producing the types of output that we need, so that we can produce goods to satisfy the demands of Americans and not rely on the rest of the world to supply us with that stuff on credit.
Let's get right back to Peter Schiff of Euro-Pacific Capital and talk to you, Peter, about investment strategy. You do like Southeast Asia. In fact, your Asia Small Cap Fund is up over 40% year on year. So it's really emerging Asia, ex-Japan, ex-China, that you like.
Well, I don't know that I'm going to X China and Japan. We're actually including those nations as well. But I do believe that there's a lot of opportunity in the Asian markets, particularly if you have a long-term time horizon. And I think eventually the Asian economies are going to figure out that undervaluing their currencies to prop up the dollar, to continue exporting to a customer that can't pay is a losing economic strategy. Look, Japan has been following that debase the yen strategy for decades. It hasn't really worked. It has slowed down the appreciation of the yen, but look at the results. Look at all the debt that they've accumulated trying to prop up the U.S. economy. China's making the same mistake right now, so are other Asian countries. But as soon as they decouple, as soon as Asian economies let their currencies rise, don't worry about their exchange rate. It doesn't matter how low the dollar sinks. Just let your currency go up. Then I think there's going to be a boom in Asia, because I think economies will restructure. There'll be more trading among the Asian economies without having to include the United States, and it will mean that the value of these currencies go up, so the value of companies that are earning revenues in those currencies will go up, standards of living will rise, real incomes will rise, everybody will benefit. And of course, you know, it's going to be painful transition for Americans, because now they're going to have to survive based on, you know, our own productivity, which unfortunately is very low. But we've been living on borrowed money, and we've had an artificially enhanced standard of living thanks to the fact that so many people in Asia have been willing to live beneath their means to support our standard of living. Well, when the Asian economies reclaim that purchasing power for themselves, I think it's going to be a real boom. And I think investors who are invested in these companies, particularly the more domestic demand focused companies that are catering to the Asian consumer, I think they're going to be rewarded dramatically, not only in the appreciated value of the stocks, but the appreciated value of the currencies that the stocks are denominated in.
Peter, you said that you were interested in China. I'm wondering how exactly you're investing in China. Anything in equities? Are you seeing the ultra-low valuations we're seeing right now as an opportunity? Because certainly domestic investors aren't seeing that the same way.
Yeah, you know, the Chinese stock market has been weak for several years, and as I said, you know, it's a long-term story. I mean, I believe that the pendulum is swinging in the right direction in China. I believe they're moving from, you know, total government in the direction of freer markets and capitalism. Unfortunately, in America, the pendulum is swinging in the other direction, and I think that that momentum is going to continue. It's not going to be,
what do you invest in? How do you invest in China?
A smooth path. There'll be bumps along the way.
How do you invest in China? What would you be buying?
Well, in equities. I mean, we buy stocks. I mean, we own a lot of companies in Hong Kong and in Singapore that, you know, have a lot of leverage to the Chinese economy. But we do invest in mainland China, in Chinese companies, and we're doing this for the long term. And I do believe if you buy the right stocks there and you're patient, there is a lot of value in that market. I think right now the sentiment is very negative, so that's, you know, you need negative sentiment to buy stocks cheap. And I believe if you hold on to them, at some point there'll be a lot more enthusiasm once again for China, and people will be paying premiums to buy Chinese stocks. You just have to wait it out. But if you're a contrarian investor, if you want to buy what's out of favor, the Chinese stocks are clearly out of favor right now.
All right, Peter, very, very quickly, you like gold, but hasn't it been acting more like a risk asset?
Well, that's because people don't understand it. You know, I think it's the safe haven asset. I think the risk asset is the U.S. dollar. But unfortunately, so many people still wrongly perceive the dollar as safe. That is going to change. People will realize that there is no safety in dollars. There's no safety in any debt instrument denominated in dollars, whether it's a U.S. Treasury or a corporate bond. And I think more people will rediscover the safety inherent in gold, in real money with intrinsic value, and a lot more people are going to buy it. The price is going higher.
Peter, always good to talk to you, sir. Peter Schiff there, CEO of Euro Pacific Capital.